You are the average of the 5 people you surround yourself with. So if you're surrounding yourself with a bunch of losers, go and change your networking circles, and your net worth is a direct result of your network.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute and every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, Freedom Fighters. In today's episode of Get Invested, I want to stretch your thinking again to consider an innovative investment opportunity that is outside of the ordinary. And to set the scene, I want to start with an appropriate quote from Henry Ford, the American founder of the Ford Motor Company. It goes like this: if you always do what you've always done, you'll always get what you've always got. It's similar to a quite funny definition of insanity I've heard, where you keep doing the same thing over and over, but expecting a different outcome. And this flows into another one of my most favourite and appropriate quotes. The secret to happiness is freedom, and the secret to freedom is courage. To me, this means having the courage to look outside the square and take calculated risks to consider investing in proven, innovative initiatives that are safe, affordable, and easy. I've always approached new investment opportunities with an unbiased open mind, and then educated myself fully on the pros, the cons, the ins and the outs, before making fully informed decisions on the merits or otherwise. My 35 years of research on the fundamentals of success has repeatedly proven that only about 1 in 20 achieve real sustainable success in any area of endeavour. And today's guest has mastered an investment opportunity where many others have only achieved fairly mediocre results. Consider this. If I could show you a low-risk, high-return property investment opportunity that could give you an 8% net cash-on-cash return per year, compared with the average of about 3 to 5%, but also gives you strong potential to double your capital money in just 5 to 7 years, with as little as $50,000 down, would you be interested? Well, this is exactly what today's guest, Reed Goossens, from RSN Property Group, has personally achieved, and is now helping other like-minded time-poor professional Aussies to enjoy the same thing. Reed's a project structural engineer from Queensland, turned successful property investor, whose business now controls the equivalent of over 100 million in Aussie dollars in rental property. His innovative multi-family syndication model is delivering low-risk, high-return and high-growth results superior to anything that I've seen in Australia. In fact, his investment model looks so strong that I'm personally looking to invest with him. So how does he do it? Where does he do it? What are the pros, the cons, the rewards and the risks? Who is best suited to benefit from this style of property investing? And how can you find out more and or get involved? Well, you're going to find out all of this, plus a whole heap more in this episode. And if you're interested in investigating it any further, please send me a quick email at bushy@khgroup.com.au. That's bushy@khgroup.com.au. And I'll be happy to share some more info with you. So please sit back and enjoy this very interesting and exciting chat with Reed Goossens. Welcome, Freedom Fighters. It's Bushy Martin. And as many of you probably already know, I've already invested in property in the USA as part of my portfolio. And it's fair to say I've done that with fairly mixed success. However, given my interest in this area and in my travels, I've come across an expat Aussie who's very successfully invested in the USA. He currently lives there, and now he helps other Aussie investors to do the same. So I'm really looking forward, and welcome aboard, Reed Goossens.
G'day, Bushy. Thanks a lot for having me on the show, mate.
Awesome, mate. Really looking to delving into the potential of the US and where that might be a good opportunity for fellow Aussies over here. But before we do that, mate, just so that the audience can get a feel for who you are and what you do, can you just give us a quick rundown, please, mate?
Yeah, mate, sure. Well, for all those listeners out there, I'm from sunny Queensland. I grew up on the Sunshine Coast and went to lived near Noosa in the hinterlands of the Sunshine Coast in Koroi, and I went to the University of Queensland and studied civil engineering and went on to, as most Australians do, go across the pond, as they say, and start travelling the world. And back in 2007, I went abroad and I fell in love with an American girl, and all these years later, I'm now living in the United States and successfully investing here as well. But really moved to the United States to be with her and pursue originally a career in structural engineering, but found other things I'm sure we're going to get into later in the show.
Yeah, definitely, mate. So, and let's perhaps build on it from there, because you've done structural engineering, and it's interesting the number of property investors I come across who are either engineers or IT people, and I'm sure that's because of the sort of structured analytical outlook that you bring to the table, which is a pretty important ingredient in the whole mix. But just so that people get a sense of that journey, if we can, mate, can you talk to us about, and let's go back to that decision when you decided to go to uni. Why did you decide to invest your time and your energy into becoming a structural engineer?
Yeah, look, it's a looking back on it, mate, it was a very methodical decision. I think I was very good at mathematics, and I just decided. I thought I was originally going to become a vet. I was really into horses back in the day. I was into show jumping. I traveled around the country jumping horses. Had a small team of my poor parents, who were both school teachers, struggling to keep their son in the horses. But yeah, realised really quickly that I was not going to be a professional show jumper, as dismayed as I was. But so I needed something to fall back on, obviously. And Dad always said, you've got to have something to fall back on. A piece of paper behind your name, whatever it might be, whatever you choose to do. He didn't really care. He just like, if you go into horses, you've got to get all the credentials you can. And I sort of said, well, okay, what am I really good at? And becoming a vet needed, I think, an OP1, which is in Queensland for all those Queenslanders out there. I only got an OP5. Not only, I still did quite well. But then sort of found out, hang on, this engineering thing looks like a pretty good idea, and got into it and really loved it. Really actually loved studying engineering. I really enjoyed the analytical part of it and the camaraderie that I developed at University of Queensland with the cohort there. But unfortunately, when you get into the workplace, you soon realise that you're a small cog in a huge giant machine, and it wasn't for me. So I hope that answers your question. But it was a combination of what I sort of loved doing, which was the mathematical side of it, but also combined with studying something that I could really sink my teeth into. But then just quickly realising when I get into the workforce that this was not what I want to do for the next 40 years of my life. Yeah,
I understand, mate. So you moved to the US and followed your love over there. You're actually working as a project engineer in the US initially?
Yeah, so a little bit of just to rewind just a little bit, I actually moved to the UK first in 2008 to become a structural engineer on the 2012 Olympic Games. Yeah, right. I had a fantastic year living in London. Yeah. And then when 2008 came, everything went to hell over there. Yeah. And I was not ready to move home, and I actually moved to the south of France and became a deckhand on the super yachts, on the mega wealthy yachts. And nice. I spent a good 12 months working for Russian billionaires on the super yachts. And in that time, I actually backpacking around, I went to the running of the Bulls and then subsequently went to San Sebastian for a couple of days to recover afterwards, and stumbled across this gal and her friends, and that she turned into my girlfriend, now my wife, and that was back in 2009. But subsequently, she actually had applied for a university in Australia. So in 2009, 2010. I ended up moving back to to Aussie, and she followed me quite soon after there, and I said, "Oh, hang on, you're moving to Australia. We should definitely start dating."
Yeah.
And then in the same time, I picked up the book Rich Dad Poor Dad, and that was the book that really sparked it all, because I was feeling really jaded about being back after spending 2 years abroad, loving life and living to the fullest. I cruised across the Atlantic Ocean on this super yacht. I had really awesome life experiences, but I was not in control of my life, but I didn't know how to do it. And it was a combination of being home, being back in a cubicle, and going, what the hell am I going to do for the next 40 years of my life? I can't be sitting in this cubicle. And the Rich Dad Poor Dad book was it was sort of this aha moment, the penny dropped. And I really felt like I was like a star athlete sitting on the sideline just watching my life go by. And I said, I've got to make a change. And I didn't know what an entrepreneur was. But through reading that book, through self-education, within I think a month of reading that book, I was at the first little real estate networking event in Brisbane, and that sort of got the ball rolling for me.
Yeah, awesome, mate. Well, it's funny, Robert Kiyosaki's got a lot to answer for because went through the same experience myself when I was starting to look at, how can I create passive income that gives me time back so that I'm not sort of nailed to a desk as an architect in my case. So I went through a pretty similar journey. But were you thinking about property at that stage, or how did Kiyosaki come into the horizon?
Yeah, well, look, mate, it was about, I think the only thing I could really boil it down to is Dad had just fallen into real estate and had done really, really well. Also combined with the fact that I was working on real estate stuff with infrastructure and building apartment buildings and roadways and all that sort of stuff. So I was in the sort of real estate space, even though I didn't know about it. And so I was either going to choose stocks or real estate. And so I sort of was like, well, hang on. Dad's been sort of somewhat successful, and he's only he's not only a school teacher, but he was a school teacher. And I thought, well, I'm in engineering. It sort of makes sense if I could use this career to leverage myself closer to developers or other people who got into this space. And it sort of the blinders came off, and all of a sudden you see the world in a different light.
Yeah.
So I guess that was why I chose real estate, maybe say over something else like stocks or buying businesses or mergers and acquisitions or something like that. Which is you can still make great money out of that, but it just was something I didn't choose at the time.
Yeah, okay. So they obviously followed your life's love back to the US, and that's when you decided to dip your toe in the water on the property side. Let's talk us through that, mate.
Yeah. So when I was, when was it? Middle of 2011, Erica was winding up her master's degree in Australia, and I'd been, obviously for the last probably year, consuming as much real estate as I could, and I was probably going to do something in Australia, whether it be a lease option or flip a house or something, but there was still a huge desire to be an expat and live abroad. And when I went backpacking through New York City, I thought, geez, I fell in love with that place. So once Eric had finished uni, I said, well, look, babe, let's quit our jobs. I quit my job, a highly paying engineering job, and I knew that there was a good visa for Aussies over there. So we just packed up our bags and moved halfway across the world, and I literally just got my portfolio and pounded the street and just kept going in and out of different engineering joints until someone said yes. And in combination with that, I was in the Big Apple, and within 2 weeks of getting fresh off the boat, I was at my first, what's called a real estate investment organisation, and called a RIA, and they do sort of monthly meetups, and I was attending those same meetups, but in New York City, and I quickly realised that these fast-talking Americans, I had to quickly learn the lingo and get up to speed real quick, and fast forward a little bit, I got my job within about a month of being in the United States, and was doing the unconventional, just walking in and knocking on doors. Yep. And I just knew it took one yes to change your life, and that's all it takes. No. You hear all these no's all the time, and one of the big lessons I've learned about traveling abroad is it takes literally one yes, and it will change the entire course of your life.
Yep.
And you got to be ready to go with it. So I did. got a job in a small engineering firm, and within 6 months of living in the United States, I'd purchased my first little triplex in upstate New York, and I'm sure we're going to get into the benefits of why what I thought was the benefits of investing in single-family real estate in the United States.
Yeah, well, let's jump straight into that, mate. So you're absorbing a lot of info around property. You obviously, I'm assuming, just used cash reserves to buy property outright, because it probably would have been challenging to leverage or get a loan at that stage of the game.
Yep, that's exactly correct. I was fresh off the boat, no credit. I had to determine what the hell credit was because something, again, I was not used to. It's a lingo that the us Aussies don't really use. Mm-hmm. So I had to build up credit, and and I bought my first property was $38,000, and I think the international perspective of coming to the United States was just like, oh my gosh. Yep. There are properties selling for less than $50,000. This is exactly what Robert Kiyosaki said. I need to get some cash flow. Yep. How the hell is this even possible? And it just sort of came to me. I was like, okay, I've got to start investing in these assets, and and that's what I did. So yeah. Yeah,
brilliant. So how did that go then, mate? So you spent $38,000 on a single family home, sort of north of New York somewhere, I'm guessing, did you?
Yeah, so I got to obviously New York, and New York City is exactly like Australia. It's like the Melbourne market or the Sydney market. It's huge expensive, but 4 hours drive north, there's a little towns called Syracuse and Buffalo and these little places like that, and I could drive there on the weekend, and it was sort of a moderate growth little sub-market, and I just said this is the only way I'm going to learn is by getting my feet wet.
Yep.
And so I found a small real estate broker in the market, and I went and started developing a relationship with the local bank. I opened up a bank account, and I knew I couldn't get any leverage, so I just thought, well, hang on, I'm just going to buy this triplex for $38,000. And on paper, it looked brilliant. And I was, each property or each unit was renting out for $850. Well, that's what the pro forma was. Nice. And it was going well for 6 months, and then it didn't go well, and we can talk about that as well. But in that 6 month period, I was able to prove to the local bank that I was getting rental checks, and I was depositing the rental checks. And typically, local banks are a little bit more fluid with relationships, so they don't have all the sort of stringent rigmarole and regulations that the big banks have. So within sort of 6 months of ownership, I was able to refi just a little bit of money out and buy a second one. Nice. And that's what I did. So yeah,
awesome. And you mentioned then that you sort of it went well for a period, and then you started to have some challenges. What were the challenges, mate?
Yeah, the challenges in and around these sort of properties is that it was I got a pretty quick lesson in understanding what a ghetto was. And coming from Australia, you Australians, my wife always jokes about the Australian hip hop scene, and no offense to anyone from the hip hop scene in Australia, but we really don't know what a ghetto is until you move to the United States. And there's just think of there's 300 million people living on the same landmass as Australia, but they can inhabit from East Coast to West Coast, and you've got everything from New York City and San Francisco on one end, all the way through to Detroit on the other, and you've got to house 300 million people in between. So it causes a lot of different, I call them tier one markets, and then you've got these tier three markets, which are not the most desirable. So, but don't get me wrong, Syracuse is a great little town, and within Syracuse it was... there's some really affluent neighbourhoods, but there's also some pretty dodgy neighbourhoods. And I happened to stumble across a little bit of a dodgy neighbourhood, and I was renting to what's called Section 8. And Section 8 tenants are, for those listeners out there, they're just government subsidised housing. And really, if you're buying a property where if the tenant can pay $850 a month to live there, where the mortgage on a $38,000, $40,000 property is a lot less than $850, you probably got the wrong tenant profile. And so that's the issue right there that happened. But I will say, I bought my second little duplex, and that was a little cash cow, $1,200 a month, and I think my mortgage was only $250, and I was spending another $400 or $500 on repairs and whatever it was, and I was cash flowing $600. So it did work, He just on the first one, he didn't work very well, and I got out of there. To be brutally honest, one of our lovely tenants, her son was part of a local gang, and there was a drive-by shooting. Luckily, no one was hurt, but there was a bullet hole in the next door neighbour's car, and he was a long-term tenant who'd lived in the neighbourhood for many, many years, and I just felt terribly guilty, and I evicted that tenant, even though it wasn't her fault, it was her son's fault, but it was still. He wasn't on the lease, and I just needed to get him out of there. So within sort of a year, about a bit over 18 months, I'd sort of got rid of that particular property. But in that same period of time, I'd realised the value of going in, spending $10,000 to $12,000, increasing the rent $100 per unit, and having the scale. I only had 3 of them, or then plus I had a second one, so I had 5 units in total. Yeah. But that was just a lot of value was created through doing very cosmetic renovations to the units and making a clean, safe and affordable place for people to live. And there's a need for that, right, here in the United States. There's a whole spectrum of poverty, and we won't get into that, but you need, as an owner of a property, I wanted to provide clean, safe, affordable housing for people. Yeah. And that's what we did. And not every single tenant's going to be your ideal tenant, but I have had proof that in many, many deals later that there are many good people out there that want to rent and treat your properties really, really well. So, and we'll get into that in a little bit. But that was sort of the start of it all. I then got in quickly I flipped a few houses in Philadelphia, another city that was on the spectrums between Washington and New York. I love Philly. It's a great little city if you ever get there. It's the charm of New York, but half the price, as I like to say. Still very block by block, but I got a row house there, and we flipped a couple of houses, and then eventually got into the big syndication, which we'll talk about in a little bit.
Yeah, because what you've just described has been exactly our own experience. So we've got a couple of 3 properties in the US, Section 8 material. It's been really hit and miss. On paper, it looked absolutely fantastic. The reality's been substantially different, and a lot of that's around the inconsistency in property management levels, and I think when you and I spoke on your podcast, Reed, you well pointed out to me that the lack of scale, given we're only talking a couple of properties, doesn't really hold the interest of a property manager who's looking for much bigger opportunities. So I think that's a very good read. Now let's go straight into that transition then into the syndication and the apartment style of exercise. Sure. Talk us through how you get onto that, and then where that's got you to now, and what the opportunity might be. Yeah.
So at the end of 2000 or middle of 2013, a very good friend of mine actually, who came to University of Queensland, a Canadian fella, who I was just his MC at his wedding locally up in Vancouver about a month and a half ago. So very, very impressed. But we've been good mates ever since uni back in the day when we were first day at college, and. He came down to New York City and just he was coming into town for some reason. I remember taking him out to dinner. I said, mate, guess what I'm doing? I've got 5 units in upstate New York, and I'm flipping houses in Philadelphia, like these cheap houses, and I feel like I'm crushing it, right? But I still have a day job. I hadn't got financially free, all those things that you need to do. Yeah. And he said to me, "Oh, mate, that is bloody brilliant. Like, well done." And he said, "Oh, I just closed on a 70-unit property," and my mouth just dropped. I said, "What do you mean you closed on 70?" And he said, "Yeah, 70 units in Canada, in a little a couple of hours north of Vancouver, in a little mining town." Nice. And I said, "How the hell did you do that?" And he went and explained about other people's money, and that's where he explained that he was able to use seller carryback financing on the property, and we're going to get some pretty crazy terms here, but I'll break it down in a bit. Yeah, great. But essentially, he was able to pool some friends and family money together, and he was able to go and he still is working as a civil engineer, but he was able to use his job to qualify for a commercial loan. Yep. And the banks in North America look at commercial property differently, how they look at it in Australia, and so they underwrite the property more. And he was able to muster up the down payment and $500,000 between I think 4 or 5 mates of his. And he was able to go and close on 70 units, and I just thought that was bloody brilliant. And it really sort of lit the fire under my belly, because what he was doing was the same thing as what I was doing on the smaller stuff. He was going into every single unit, putting in $5,000 or $6,000, liquor, new paint, some new appliances, some new flooring, and then charging $100, $150 more. But if you do that across 70 units, and you have such a bigger scale, and that then with commercial property and lending, the way in which they lend in North America is they look at the property as a business. So if you increase the net operating income of any business, you inherently increase the value.
Nice.
So raising on my 3 units, raising $100 doesn't really move the needle, because 3 units.
Yeah.
For those people, listeners out there, it's not a commercial asset. Anything 4 units or less is residential, and then 5 units or more is classed as commercial lending.
Yep.
But the overall principles were the same. I was applying the same principles in my triplex as he was applying in his 70 unit, and I just thought to myself, "Wow, that's incredible." He's through going in and spending $50,000 or $60,000 on 20 of the units, he was able to increase the value so significantly, and the cash flow at the same time, and was called forced appreciation, and it was something I'd never even heard of, and something that I was really, really intrigued about. And then then he was talking about syndication, and that is where that got the ball. It was the second penny dropped for me, and through. And I said, well, how the hell do I get started? And he told me that he got a mentor and he'd done all these things, and surrounded himself with a team. And cut a long story short, it sort of really inspired me to get off my ass and go get a mentor. And that's what I did within literally a month of having a conversation. I knew that I'd had to take my investing career to the next level.
Yep.
And I knew that I couldn't do it by myself. Yes, I had mixed success and had got my toe and got wet in sort of these little triplexes and flipped a house here and there, and it was all great. Yep. But it still wasn't the sheer scale that I needed to create a business around it, and that was where syndication came into it. I really needed, like a good football player or tennis player, you need a coach, and I needed someone on my team to really up the ante, and that's what I went off and got a mentor and a coach, and that's how I started the business. So,
yeah, brilliant. So talk us through then where that's led to, and then I'm keen to jump in and look at, okay, well, what's the opportunity for Aussie investors to perhaps look at this as an option for them?
Yeah, sure. So, let's first explain what maybe the syndication model is, and think of it like a plane, right? And I'm going to use a small plane or a big plane. If you went and tried to hire a plane, regardless of what size it is, to fly from Brisbane to Perth, it's going to probably cost you a lot of bloody money. But if you go and split the cost of that flight with 20, 5, 10, 15, 20 other people, it's a lot cheaper. And you get to still achieve your goal of getting to Perth, from Brisbane to Perth, for a fraction of the cost, and everyone gets to share in the benefit of flying across the country. Yep. So think of that like syndication, and that's where you pull everyone's money together to go and buy an asset that you may not have been able to go and buy or purchase as an individual. And by doing that, you're able to open yourself up to going and buying lower risk assets, and we'll get into what low risk means, but essentially it's pulling people's money together to go and buy larger and low safer assets, particularly here in the United States. That's sort of that's a high level look at it.
No, and it's a very good analogy, mate. Actually, very good analogy. So talk us through what you've done in that space to date, both personally and with other investors, so they get a sense of the scale and the size and the type of thing that you're looking at.
Sure. So, a lot of people say, well, how do you get started? The big thing, you're essentially raising money from private investors, friends, family, colleagues, your sphere, to invest with you. And how do you get that confidence from investors? Doing a couple of single family flips and doing a few triplexes in upstate New York isn't really going to move the needle from someone who's going to want to invest potentially 6 figures or more with me. So through my mentor, I was able to ride it on his coattails and use his experience to raise a small amount of money from my friends and family to get involved in his deals early on. Okay. And through doing a number of those deals and getting good credibility, because that's what the whole thing is about, is building that credibility, I've been involved in about just with his back in the day, was in the early days before I branched out on my own, We probably did about $100 million worth of real estate. Now I was involved in a fraction of that, raising a fraction of money for that.
Yep.
But it enabled me to get the experience, the credibility, and I was able to build my own brand around what I do. Since going out on my own and doing it with my business partner, we currently control personally $70 million worth of multifamily real estate here in the United States.
Yep.
In the Texas market. And we syndicate. So we offer people a place where they can park their capital. They get a return on their money each and every year from cash flow, and then we have an exit strategy in 5 to 7 years' time where we look to try and double investors' money in that time. And people might be thinking, well, how the hell you do all that sort of stuff? I'm sure we'll get into it, but in general, we offer people a place to invest who don't necessarily have the time nor the energy to go out and find the type of deals that we find.
Yeah,
so I hope that sort of summarises it.
It does. So when you're talking these apartments, we're talking what sort of numbers in terms of the units, etc. that you're.
So we're talking, above 100 units or more in a complex. So when I say a complex, for those Australian listeners out there, think about 100 unit garden style apartment, sort of 3 stories. Maybe they have 10 to 15 buildings on the one site, and that's all on one parcel of land, and it's sold as a whole entity. Like in Australia, where they would sell off strata title, and everyone would own an individual piece of that 200 units or 100 units. In America, you buy it as one whole piece. So that's the difference. It's what is called multi-family apartment buildings, and something that doesn't actually exist in Australia. And I'm sure a lot of investors would be scratching their head going, what the hell is a multifamily? But that's essentially what it is. Garden-style apartments in what we like to call Tier 2 markets, where they've got moderate cap rates, good affordability, their GDP growth is growing, low unemployment, and multiple employers compared to, say, somewhere like LA or New York City. So you've got, as I did the analogy before of the LA, New York's on one end and Detroit's on the other, where they've got other markets in the United States, like the Texas markets, the Dallases, the San Antonios, the Austins, the Houstons. You've got the Charlottes and the North Carolinas, the Charlotte, North Carolina. You've got Tampa Bay, Florida. These sort of secondary markets where the affordability, people don't, still need a place to live, and it's a lot more affordable than, say, a San Francisco or a New York or an LA. Yes. And again, going back to that analogy, that 300 million people to house, you're going to have these what's called Tier 1, Tier 2, Tier 3 markets across the country. And then we tend to look for those strong growing Tier 2 markets in the United States.
Yeah, Brent. Now, just while we're talking about it, because the closest analogy multifamily to Australia is the apartment market. Now, there's a lot of bad press in Australia at the moment about the oversupply of apartments in the likes of Sydney, Melbourne, and Brisbane, and to a lesser degree even Adelaide. Because there's just been so many Chinese investors going and building these things en masse, and then just effectively land banking. They're not even putting tenants in them; they're just parking their money from overseas. So it's pretty important at this point to clarify why multifamilies of a similar model are successful from a cash flow perspective in the States versus all the negativity that they might be hearing around the apartment market here. Can you sort of clarify that for us?
Yeah. So let's clarify what is multifamily. So it goes back to the financing arm of it, and in general, the Australian market has limited financing options. So what do I mean by that? So in the States, we are here. There's thousands of financing options, and the fact that commercial real estate is viewed in the United States, and that includes multifamily, so 5 units or more, it includes self-storage, it includes hotels, it includes office or retail, they will value it on the net operating income, that building, the overall building, not the individual units in the building, but the overall building as itself, the 100 units or the 100 square meters of retail space. They will view the income, the net operating income of that property as a business. And if you can increase that, and they'll lend on that. So they don't look at you as the borrower as much. They look more at the building itself and how it can produce cash flow.
Nice.
And so in Australia, the reason, and I've talked to a lot of Aussies and a lot of my Aussie mates here who are in property and real estate, why doesn't the Australians, or why don't we have it? And it's because what I can really concoct, and Bush, you probably know a little bit more than I do, but it really comes down to what I think is just the access to financing and the fact that, in ground up construction in an apartment building, a construction loan won't get involved with the deal until you've sort of pre-sold X amount of units off the plan.
Spot on.
And through that, you're then forced to do condos. So the condos do exist here in America, and that's where they will build 100 units. They'll sell them individually, and it's called a condo market.
Yeah.
But we also have the multifamily market where you can blend on the entire building as one and look at the future NOI and say, okay, well, I'm going to take this future NOI, divide it by what's called a market capitalization rate, a cap rate. Yep. You can then derive a value out of that. And
nice.
And I'm sure a lot of your listeners are probably scratching their heads, but
no,
that's kind of in a nutshell the access to financing.
Yeah, no, I like it. So because they're looking at it as a business and they're looking at the cash flow of that business, and then they're just applying a multiplier to that income to say, well, based on that, this is what we think it's worth. So what I'm hearing you say is that if you go in and let's keep the maths easy. Let's say we go and buy a 100-unit multifamily, and we add $100. We do some tarting up to the properties with some paint and some new floor finishes, and perhaps redoing some tiling and some wet areas, etc., just to give it an aesthetic lift, which lifts the rental income by let's call it $100. Then you times 100 by 100, and then times that by the value
12.
multiplier, and all of a sudden they're saying, well, now this development is worth X. So you're actually creating capital growth effectively by the improvements that you've instituted. Yeah, that's nice, mate. That's
exactly.
That's a very different model to Australia, and a pretty exciting one in the fact that you're not relying on time in the market to lift the value of the property, because in my own experience I saw there was very little market growth generally, apart from, we bought properties pretty soon after the GFC in 2011, and on the basis that the Aussie dollar was $1.05 at the time, and if we bought them at half their value and all they did was return to their long-term value, we'd still double the value of the property. But beyond that, there was very little likelihood of ongoing capital growth. What I'm hearing you say is that you're actually manufacturing that growth by the improvements you're making that lifts the rental income, which therefore, by virtue of that, when you're talking to someone, effectively lifts the value of the overall development.
Correct. That's exactly. You've nailed it. You've nailed it completely. Nailed it on the head. So really,
nice.
Good summary.
That's really good. So what I'm hearing on that basis then is that, and I'm pretty keen to dig into this for the benefit of listeners who might be interested in it, is the sort of cash flow returns they're likely to get, and then the sort of uplift that they're getting in the value of the development as a result of the improvements that you're making to it. So let's go through an example. So describe the ideal investor that will be looking to put money into one of these, mate, from an Australian perspective?
Yeah. So the ideal investor is obviously someone who I spoke about earlier. Back to that plane analogy. Think of the captain and the co-pilot is the business. Me and my business partner, we're the pilots. We're driving the plane.
Yep.
You have some people in first class, and you have some people back in coach or economy who are looking to come along for the ride. They're the people who don't necessarily want to roll up their sleeves to find the deal. They don't want to find the deal. They don't want to oversee the management. They don't want to negotiate the contracts. They just want to place money in this investment, in this vehicle, and sit back and really be an armchair type of investor and receive what's called a preferred return. Yeah. And in some structures, we have what's called a preferred return. And you can't guarantee anything in real estate, but the next best thing you can do is say, well, the first X percent of cash flow goes straight to the investors. Yeah. And we, as the captains and co-pilot, we won't participate until you've hit that threshold, which is called a waterfall structure. But it won't confuse anyone.
Sure.
But it's not a guarantee, but it's the first X% of cash flow goes to the investors, and then anything beyond that is split, 70-30 typically, where 30% goes to us as the operators, and 70% goes to the investors. And so over time, we look to, as you were saying before, we look to come in and we might buy 100 or 200 unit property. And over a period of 12 to 18 months, we will do renovations, right? Because we can't go in and just do the renovations.
No.
It's an existing asset, and they've got new tenants. The tenants are in there, and you want to keep the occupancy up, so you want to keep the cash flow going.
Yep.
But there's natural vacancy. So we'll get into, every month there'll be people moving in and out at any one given time throughout the year, probably more so in the summer than they do in the winter.
Yep.
But as they move out, we will highlight a handful of different units that we'll go and turn. We'll turn them in about a month, and then we'll put them back on the market and say, hey, look, they've been rented. We'll put new flooring in. We'll put new light fixtures, put new appliances in. We're going to raise the rents $150 because we know that we bought the asset where the rents are compressed in that particular market. We look at where the rents are trending to other different similar asset types in that particular market.
Yep.
And we'll then go through a process of 12 to 18 months of trying to get through at least 70 or 75% of the unit turns. We'll also look to do up the leasing office, do up the gym, do up the recreation centre if it has one, and really make the overall appeal of the property nicer for people who want to live there and attract a better type of tenant, and overall increase the value of the property. So in a nutshell.
Nice. No, that's good. So let's say I'm Joe Bloggs and I've initially looking for a good cash flow return on my investment. What sort of profile am I? What sort of income am I? What sort of equity do I need to have in my back pocket to contribute?
Yeah, you're probably that mid 40s, high net, medium to high net worth individual or high income earner. So
can we put some numbers? Put some numbers around that for me.
Yeah, let's put some numbers to it. So you're probably earning $150,000 or more a year between. Maybe $200,000 or more a year between you and your wife, and you want to invest. You've got some either self-directed super funds, or you might have some spare cash lying around that you want to get working for yourself rather than sitting in the bank. And you're sick of getting the bank, and you want to get it out of the bank because CDs or bank accounts only pay 0.25%. So you want to get it working for you. Typically, our return profile is we offer between a 6 and a 7% preferred return. That's an annualized cash flow each year. Yep. And then we look to double our investors' money in 5 to 7 years' time. And for those sophisticated investors out there, if the internal rate of return, we try to target it between a 12 and a 15% return over a 5 to 7 year hold. And really the benefits of investing in real estate is if some of your listeners may or may not know is you get the tax benefits, right? So you go put your money in a stock market and you may get a 7% return. Well, that's not a true 7% return because the government's going to want to take some of it because it's not a hard asset. In real estate, you can depreciate and offset the taxes by depreciating the value of the property over a period of time. And in commercial real estate, particularly here in the United States, we get to do an accelerated depreciation schedule because of just certain business benefits of investing of the US. And that is a true, if we're giving you a preference, a true 7 or 6% return every single year on your money. And then as we come to exit the deal in 5 to 7 years' time, we will obviously the improvement that we've done to the property is that it's grown in value and we can sell it at a premium and everyone gets to benefit in that sort of return.
Okay. So let's do a quick example. And what sort of a minimum would I need to be kicking in as the initial deposit, mate?
Yep. So we have our minimum investment set at about $50,000 to buy shares into any one deal. So not a huge barrier to entry, but the way in which we structure it. So if we're going out and buying property number A, which is 150 units, we will just raise on that property and that property alone. So we're not a fund that goes and raises a blind pool and say we're going to buy 6 assets somewhere across the United States, we're saying, okay, you're buying into ABC Smith Street in San Antonio, Texas.
Yep.
And that return profile of this particular asset is XYZ, and you are a part ownership or a co-owner in this deal. And that's it.
Yep.
And you'll get, your quarterly statements and quarterly preferred return payouts. And, you can, every time you're in San Antonio, come and visit the property. But then if you want to invest in another one of our deals, you can do so as well. And that's why the barrier at $50K, it's not set too high. So you can diversify into multiple assets. So it's not all tied to one investment, because that's what your diversification is obviously the biggest thing. And we want to have equity preservation. And that's the most important thing over why you invest in real estate, is to preserve your equity and preserve your money.
Yeah, exactly. So if I let's say I kicked in $100,000 and I put it into X development or X multi-property exercise, then I could expect to get on that preferred basis a sort of 7 to 8% per year. And then then at the end of so you sort of set the end game at a sort of a 5 or 7 year horizon when you then turn the property over, do you? What's the, and
that's correct.
That's where and then I can get
that's where you get your exit, and so we will talk before we dive into that. Let's talk about what is the exit. So what do I bring to the table as the operator? You might say, well, God, he's going and raising all this money from these investors, and he gets 30% of the deal. What the hell is he doing? Well, what I'm doing is bringing the bank financing to the table. So we will raise typically between 25 and 35% of the equity needed. Like any down payment that you'd go and put on a property, we need to raise that. Now, I'm not just sitting on $10 million worth of equity to go buy a $40 million deal. Yeah. But I'll go raise that $10 million, and I'll put my own money in the game, so I've got skin in the game. But I'll also bring the bank loan to the table. Okay. And the biggest thing about the United States is that we talked about financing, is that in the US, they have some very good financing options for commercial real estate, and one being the agency loans, which is Freddie and Fannie Mac. Freddie Mac and Fannie Mae. Okay. And they are backed by government bonds, and that's the way the government makes money, right? Yep. And they put them into these long-term fixed loans, and we go and get 12 or 15, 10, 12 years fixed. I'm talking fixed interest rate loans amortized over 30 years, and we typically can pick them up with 4 or 5 years interest only on the front end. Nice. And we can, allows us to go and do the renovations on the front end and get into the deal and make sure it cash flows and gets stabilized over a period of 2 or 3 years. Nice. So in terms of risk and where interest rates are going and all that sort of stuff and what we bring to the table, we as operators need to be, have a net worth. We need to qualify for these loans, because these loans don't just give them out to anyone. They only give them out to experienced people who know what they're doing. Yep. And the risk is extremely low, because and also the big thing, it's non-recourse. So no investor has any sort of recourse whatsoever. Wow. It is all, again, backed by government bonds. And because the US views my investment, or the multifamily investment, as an asset, and if for whatever reason the deal goes south or whatever it might happen, they may have to take it back over. They're not going to come after me, and the investors would never come after anyway, because it's a non-recourse loan. Yeah. So in terms of risk across the board, there's a lot of things we do there that mitigate risk. Yeah, now let's talk a lot of things.
Yeah, and you've covered a few things there that a few of the listeners might be scratching their head on. So just to explain that a little bit more, non-recourse, as opposed to Australia, if you go and get a home loan or a commercial loan, they're all done on the basis that if something goes belly up, the bank will come and take you home. They've got the ability to come back and recover the funds, either from selling the property, and if there's a shortfall, they'll go after whatever else you've got to cover their position. But a non-recourse, what you're saying there is that if something does go wrong, then the investors aren't effectively personal guarantees for the financing of the deal. Is that what we're saying?
Yeah, yeah, exactly. But also the way in which you would never, ever, the way in which we structure the deal, that no investor takes on any personal liability whatsoever. It's the way in which we structure it as that me and my business partner, as the general partners and the managers of the deal, we are the ones with our neck on the line, not the investors, and it's protected through the different, the way in which we structure it, but also laid on top of that it is a non-recourse loan. So the only way it becomes recourse if you do anything fraudulent, like try and steal money and go and go piss off to Mexico.
Yeah,
excuse my language, but
of course, that makes perfect sense. Yeah. Okay, so that's really de-risks it from a investor's perspective, and it's from what I'm hearing already. As far as risk minimisation, you've got multiple streams of income from the property. You've already funded in the uplift to the properties progressively over a couple of years as the opportunity becomes available. You've then, as a result of that income increase, you've then automatically, effectively, given the commercial model over there, increased the value of the property. When it comes to that 5 or 7 year horizon, then are you physically selling the property, or are you getting it revalued and cashing out, or what's the exit strategy at that point? Yeah,
well, there's a lot of exit strategies. Depending on where you may be in the market cycle, it may be prudent to sell to another investor. Or the market cycle might not necessarily suit where we are, for the maximum returns, but maybe we've created so much value in the last 5 or 7 years that we can come and take some of that equity out and pay back investors, and they can go do whatever the hell they want with it. But they'd still have their position in the deal. So number of strategies. There's also a third strategy where if you have a really good interest rate, long-term fixed rate debt on the property, and you come to 5 or 6 years, and you can sell it to an investor who can assume the loan from me. So there's a number of different ways that we can exit deals here in the United States, which obviously we as the managers will look at the best time to sell to maximise the returns for the investor. So,
okay. So you're effectively really controlling that exit strategy from the individual investor's perspective who's stuck money into the deal. They're pretty much at your mercy in that regard?
They are, but that's because you're investing in our assets because it's real estate. You may be investing through a self-directed super fund or whatever it might be, and you know that it's going to be liquid for a period of time. Now, we obviously the more runs, the more turnover we can get. Hopefully, we go and sell a deal and you make some money. You want to invest in our next deal because you want to keep rolling it over. And another benefit of here in the United States is that any capital appreciation that we get on a sale of an asset, we can roll it into a like kind asset and defer the capital gains tax for a period for continue a long period of time. So what does that mean? Is that if you go in and we get we double your money, that money can be rolled over into what's called a 1031 exchange, and we can go and buy a second property with the capital gains from the first property. And that then essentially, keeps the nest egg growing and growing and growing. So or the investor wants to take their money and go and do something else with it. But whatever they want to do, there's many opportunities here in the United States to be able to maximise the returns and really create that long-term wealth.
Yeah, okay, and that's great. Now, one other thing that's probably in the minds of some investors who haven't looked seriously at the United States, they might be thinking, well, what's the tax treatment there? And then if I do try and pull the money back into Australia, is the Australian government going to have a crack at me again? Can you just sort of very briefly give potential investors a bit of confidence around that treatment?
Yeah, so there's the United States tax United States, the US and Australia tax treaty, and whatever the taxations you pay. Again, I'm not a CPA, but the taxation owed in the United States would be credited back to the Australian ATO if you were ever to sell or earn money or whatever that might be. And the strategy is that you would want to keep your money in the United States for a period of time and then look to bring it home upon a sale or upon a refi or from a capitalisation. In terms of how the ATO will treat it, in your individual cases, I always encourage people to have two CPAs, one in Australia, one in the United States, because there's slight nuances to that sort of stuff. But in general, there is a tax treaty, and what why we're in the Western world, the tax codes are written in favour of people who invest in real estate, because the Western governments are not in the business of housing people. So the same sort of taxation benefits apply as here in Australia, also as in the United States, as they do in Australia.
Yeah,
so,
in a nutshell, just to reinforce your point there is no double taxation in effect. Knowing that personally, the way we've set ours up, we generally park the money in the US, wait for the exchange rate to be preferable, and then and only then look at pulling back portions of it so that we're optimising the crossover when we pull money from USD into Australian dollars. So
and a lot of the investors would also be asking about the exchange risk, and there is exchange risk, and you have to take that into consideration as well. But it's also something that I see some investors try to play a double-edged sword and try to do it, get two bites of the apple. But any time that you're investing for long-term growth, like you talk about on your show, Bushy, is that you're there for a period of time that you want to see that grow over a long, extended period of time, which then hopefully makes the foreign exchange risk a lot less. Yeah,
exactly right. Exactly right. No, that sounds very interesting, mate, because I'd assumed before talking with you today that it was mainly a cash flow play. But what I'm hearing is that with the uplift that you're doing to the properties to reposition them, you're actually manufacturing capital growth that in an opportunity that you wouldn't be able to realise on a similar basis here in Australia. So that's pretty exciting, mate. Because if the banks are looking at that as a business and you're creating that value without relying on market conditions to do it, then you can cash that money out based on the bank's assessment of it rather than what you're actually going to sell it for, then that certainly creates a pretty good opportunity to reinvest those funds in similar opportunities ongoing. So that's got some real merit, mate. That's a pretty exciting model, Reed.
Thank you very much.
So
I didn't come up with it.
No, but it's a good one. And so if an Aussie investor that someone who's got a couple of $100,000 combined household income and might have a minimum of 50, but somewhere between 100 and 200 grand's worth, that potentially that they're considering or have already established a self-managed super fund, and they've got funds in there that either sitting in cash or shares that, in the Australian market at the moment, mate, when you take inflation out of it, cash is underwater. Shares might be giving you 3 or 4% net. If you've got it in Australian property, if you're doing really well on a cash flow basis, you might be getting 5%. So if we're talking, sort of ongoing cash flows of somewhere between 6 and 8%, and then the potential for 12 to 15% or doubling your investment over the term of the 5 or 7 year proposition, that's a pretty attractive exercise, mate.
No, it is, and that's what when I first moved to the United States, just realised that wow, this is just a different type of level of investing compared to what we're used to in Australia. And what I tell a lot of American investors is that you're bloody lucky that you got this in your backyard, and if you are sitting on the fence, don't, because I've come from places like Australia, and there's nothing wrong with investing in Australia, just that there's not the type of financing options, and there's just different models in which you create wealth in Australia through property, and it's just a different way, and for better or for worse, I really enjoyed the benefits here of investing in the United States, and that's why I love it, and that's why I try and offer other internationals the opportunity to do the same thing. Yeah,
I guess the added protection here is that what I'm hearing from you is that on the projects there you're looking at, you've physically got skin in the game. So you've got a personal commitment to
Correct.
Make that work, not only for the investors, but you personally, because you're looking for the same sort of result, which is certainly something above and beyond anything that myself and my good wife have personally been able to secure over in the US. What about giving us some comfort around the team aspect? Because in my own experience, as I mentioned briefly before, I guess we had an expectation of the levels of professionalism in all key aspects of the game, being that accounting, legal, titles, property management, maintenance, and have been pretty sadly let down over time. How have you enabled, and given that you're on the ground, this has certainly helped because you can eyeball the people to look at the good, bad and ugly, and you can monitor the performance to make sure that if they're not up to scratch, they either pull their socks up or you find someone else. But give us a level of comfort around how you are securing the consistent level of service from that property team to make sure that you're optimising its performance.
Yeah, so the big difference that I noticed making that transition from single family into multifamily was, and talking large scale multifamily, 100, 150 units, is that when you're getting a, say, 10% property management fee on a single family property that only earns $850 a month, it's only $85. You need a lot of single families for that person or that property manager to really pay attention.
Yeah.
When you're getting 3% on gross income of upwards of $1 million a month, it's a little bit different ballgame. So you have just different systems in property. The property management world in the commercial sphere is just so much different to what it is in single family, small multifamily stuff. You're getting out of the mums and dads sort of field and into institutional quality third-party property management who are professionals in what they do. Yeah. So in terms of we've geared up with a couple of, depending on the market, we've got certain markets have certain better property managers, and we obviously sniff those guys out. And they where they have their teams around them. We have on-site. So on any one property, depending on where you're investing, the rule of thumb is that you're going to have, for every 50 units, you're going to have one full-time employee on the proproperty. Okay. So if we had 200 units, you're probably looking at having maybe 4 to 5 full-time employees. You probably have 3 staff on the interiors, so doing the leasing, and you probably have 2 full-time staff on the maintenance doing the exterior stuff.
Okay.
Then we also supplement that with a third-party general contracting company who will come in and do the heavy lifting on terms of doing the siding, updating the leasing office, updating the gym, painting doing the units, doing the unit turns. So the on-site team can just focus on leasing the property.
Yeah.
And third and fourth, and then within any good team, we have obviously our CPAs, and we also have our lawyers. And they combine to, we're working with a few folks. Again, depending on the market where we're investing in, we will try and sniff out the best use, because that's what we do, right? We've got to go out and find the best in the market to make sure that we're getting the best value. Yeah. But also what we're doing, which is interesting, and something that I'm very, very interested in is because we are starting to get so much scale in what we're doing. We now have close to 1,000 units in our portfolio. I can start, instead of going directly to, the equivalent of Bunnings in Australia, the Home Depot here in America, we're going direct to China and getting all our flooring and lighting fixtures and plumbing fixtures, which means that we can do our unit turns for a lot cheaper than the average person who's going to go and try and buy a 200 unit, a single 200 unit property.
Of course. And
through that scale that we've now created other systems and businesses within the business in order to help the investor to be more. It's a stable investment opportunity because we can control more of the pieces of the supply chain, which is definitely something we know as a business operators that's what you've got to do in order to really make the system work and the team work.
Yeah.
So
again, the fact that you're on the ground and you are personally investing in these opportunities, and then you're also on the ground managing the managers to make sure that the team's performing. And that's been, I can't tell you how many late nights I've had on Skype calls and phone calls to the US trying to sort things out from afar. And it's been a headache, to be perfectly honest. And I've always operated on the basis that if you're going to invest, you don't create a second job in the process. What you're
100%, and that's exactly right.
Well, what I'm hearing is that you're handling all of that. So we've got an Australian who understands Australians, living in the US market, investing in these things personally, is physically managing the teams to make sure that things are performing well. You're picking up the economies of scale to reduce the costs of any of the improvements you're doing, so that, again, you're improving the return and reducing the risk to the investor. It's a really good opportunity, mate. I would be keen to personally have a further chat to you about it in any case, because I can see that given where I'm at in the life cycle of our investment journey, good good solid cash flow is what we're starting to look at, and this is certainly something I'll be personally keen to investigate further, mate. So, very
awesome.
exciting, very exciting. Now, tell me, mate, sort of coming back to more general terms, and it's sort of in the context of the Get Invested approach that we normally have. I've sort of found over the years that most people invest in work, career, or their business, and they focus on the income side, whereas those that achieve true freedom financially also invest in growth assets to replace their income passively over time. Clearly, you are currently investing in these multi-families as a means to do that. Is that the end game for you, or if I look long term, what's the investment strategy looking like for you personally?
Yeah, mate. Look, I've always the beauty about getting involved in commercial real estate and just in real estate in general is that you start to identify different businesses within the business, and then I talked a little bit about the sourcing product. But really, for me, my investment strategy is like a table. Acquisitions and buying real estate is the biggest leg of the table, but it is one of the legs. I mean, you can't just have one leg; you have to have other things that support it. Yeah. So it might be, creating a business through supply chain coming out of China. So that's one leg. It might be that you bring property management in house. And become more recession-proof in a downturn where you may not be buying as much property as you thought you might be. So there's another leg to the table.
Yeah.
There also, within the commercial quote-unquote realm, is other cash-flowing assets, like looking at self-storage, looking at office spaces, looking at hotels. All those assets produce cash flow. It's about the strategy in which you apply to whether you're doing ground up or you're doing more of the buying the existing asset and tweaking the knobs. Yep. But whatever it might be is that I'm really trying to build an ecosystem of businesses in order to make the overall table really, really stable. And, when one of the legs is not performing at its peak, I've got 3 or 4 other legs that are, there to support it and keep everyone happy and make the business keep ticking along. So that's really what I'm focused on. And given my engineering background, I'm really focused on those sort of systems-based type of business creations, because it just, once you take those blinkers off, you see how the world works and where you can start controlling different pieces of the pie really, really intrigues me. So yeah.
Brilliant, mate. That diversification that you're looking at in terms of, again, reducing risk but maximising income flow is ideal. When you get to the stage of, wanting time back to do other things, because I often say that most of us are rich in terms that we all have pretty good incomes, but we also put a lot of hours into manufacturing that. Whereas the truly wealthy are those that have actually got time on their hands to pursue other interests. How are you going to make that happen once you sort of get each leg of the table performing nicely and you've got that stable? How are you sort of going to free your time up to be doing and pursuing other passions?
Yeah, look, and everyone, when they say, let's go achieve financial freedom and cash flow and all these buzzwords, at the end of the day, no one's going to sit on the beach for the next 40 years of their life. Exactly. You think you're going to, but you honestly, you get bored, excuse my language, you get bored shitless pretty quickly. But, what's another thing you're going to go create? And one of the biggest things that I've really enjoyed about this whole process is, we talked about back at the earlier the conversation about why I chose engineering, and it was I very much have a black and white brain, but through creating a business, through creating my podcast, through creating a thought leadership around what I do and inspiring others to achieve financial freedom, I've created something more of a grey brain, and I've never had that in my life, and it's really, again, goes back to that Rich Dad Poor Dad book, that I knew I needed to do more with my life than sit in a cubicle. I didn't know what. And it was really about being in control of getting up and controlling the time and the people who I spend it with. Yeah. And as Tony Robbins says, it's, you're wealthy by, how much time you spend with who you want, when you want it, and on what terms you want to do it. So it's really about the sharing. I love collaborating, like doing this sort of stuff with you, mate. It really gets the juices flowing. Yeah. I always get off a podcast, kicking my heels in the air, but also providing education and value to other people, because it really does at the end of the day, help others, to take the blinders off and see that there's other things out there in the world. And as the world continues to change, we as entrepreneurs and investors and people who are, wanting to, have more freedom in their life, you need to change with it. Yeah. So you need to also be humble enough to continue learning. And I never am one to say that I've achieved it, I've done it, and put up my heels and off I go. If I stop learning, I'm stop growing. Yeah. So for me, it's about just surrounding myself with other, great people like yourself, mate, and really just learning from the best and collaborating as much as I possibly can. That's really what it boils down to.
Yeah, love it, mate. That's awesome, mate. I want to kick into what I call the ambush or the bushfire round, where I sort of cover off on a couple of questions that all the listeners keep asking me about. So, firstly, mate, what's your favourite quote that you sort of might live your life by? It might be your own, it might be someone else's, and why?
Yep, I've got two of them, if you don't mind me, and they're both from my parents. One is, a fool and their money are easily parted, and that was from my dad. He always used to tell me that a fool and his money will easily come apart in certain times. So what does that mean? It really means go out and educate yourself, get increase your financial IQ. If you don't know what a P&L is or profit and loss statement, figure it out. There's a lot of, we live in 2018, education is at our fingertips on YouTube, on these audio books, on podcasts and stuff like that. Go out and be self-taught. And the second one is from my mum, who unfortunately passed away just recently, but she always used to have one saying, we're not here to fuck spiders, and it's, you're not here to stuff around, and you're here to make the most out of your life. And if you're not happy with what you're doing, you're the only person who can change it. No one's going to walk into your living room and give you your dreams or your goals. So, get off your ass and make the most of it. And because we only live once, and it's really come into the fore as, unfortunately she passed away recently. And I really now started changing the way I live my life, and thank you. It's just about changing the way I approach it, my attitude towards things, and really trying to be, positive in every way I can be. And because at the end of the day, it's only me who's telling the stories in my own head about, or whether this and that, or I can't do this because of this and that. It's all these stories that you tell yourself. You're only getting your own way. So they're the two sort of quotes I like to live by.
Mate, God bless your mum, and condolences,
Thank you.
mate. It's pretty tough when
Thank you very much.
You lose the folks, but mate, that has got to be quote of the year. We are not here to fuck spiders, mate. I absolutely love that, mate. I'm going to put that on the top of my PC after I get off this podcast, mate. That is an absolute cracker. So, mate, next question on the bushfire list. What's the top book that you'd recommend people buy? Now, you've mentioned Robert Kiyosaki already, and that's a favourite for just about every man and his drover's dog when it comes to investing.
Yep.
So that's a cracker. But what others that they may not have heard of that's been useful to you, would you suggest them having a look at?
Yeah, Think and Grow Rich is one.
Yep.
I think I've been banging on I know the boys have been on your show, but the KPI boys, the key person of influence, for anyone who is thinking about, getting ahead in this digital age, I think that was a really different book for me to think about. And I'm not, again, goes back to my black and white brain. It was just a different way of me thinking. And I would never have thought that, after being an engineer, I would be launching a book and on a podcast and having a personal brand. And it just goes back, looking back over the 6 or 7 years that I've been in the United States, it's being willing to transform yourself, and I guess that was a book that sort of really helped me do that. So Rich Dad Poor Dad, probably for the guys who are just getting started, just wanting sort of inspiration. For the more of those business entrepreneurial type of fellas out there listening to this who want to take that control of their life, maybe a key person of influence book. And then the Think and Grow Rich is another fantastic book that I really, and then obviously the 4-Hour Work Week is another great one as well. So one by Tim Ferriss.
Yeah, brilliant.
So,
that's another cracker, mate. That's certainly been quite instrumental in what we're doing now, mate. Now this is probably a little bit less relevant given that you're in the US, but it's certainly something that everyone continuously asks me because there's a sense in Australia that we all pay too much tax. What's the top thing that you've done to pay less tax, mate?
Top thing to pay less tax is also, I'm going to keep harping on it, is education.
Yeah.
So being educated on what that don't look at the tax code as something that is scary. The tax code in the Western world, and I know two of them very well, the Australian one and the American one, they're written with investors in mind, and they're there to benefit you. If you think about it like that, it's actually written in a way that you can help you reduce your taxes. So understand it, get really, really focused on how to structure certain things different ways to get creative, and you'll be just fine. And obviously investing in hard assets is a great one, because it goes back to what I said before. In the Western world, the governments of the Western world are not in the business of owning real estate. They are in the business of being governments, and so they have tax benefits for those who do. And so getting your money out there, working to in a hard asset is definitely the best way to and then the way in which you structure it and all those sort of things, and how you leverage certain your income and all that sort of good stuff. But it does boil down to education, and it boils down to not again, a fool and their money are easily parted. Go out and don't ever think that you know it all, and just think that, oh gosh, I'm going to be taxed till the hilltops because I don't know what I'm doing, and that's ignorance. And I can't stand ignorance. So get out there and get educated. Always keep learning.
Yeah, no, brilliant, mate. Now, slightly different twist here, but what's both the worst and the best piece of investment advice that you've ever received?
Okay, let's talk about the best piece of investment advice. Well, I think the best, in looking back on it, mate, we've all had our failures, and everyone talks about success and all this sort of stuff, and it's great success, this success, that, but you actually learn the most from your failures. And failing fast or failing forward is something that you shouldn't be afraid of. And I guess that's a really good piece of advice, is that everyone's so fearful of taking a chance because they're going to fail. You're going to set yourself up for actual failure in the long term. So being okay with backing yourself and making a decision, and if it doesn't work out, always know that you've got a plan B, or like me, moving halfway across the world to pursue a girl and pursue a dream. The thing was, well, the worst case scenario, I moved back to Australia, which is a pretty bloody good place, and I'll just get a job and I'll keep going with what I'm doing. So it wasn't the overall the failure part of it wasn't the hard part, and when you can rationalize it like that, you sort of can back yourself a little bit more and say, well, if that's the worst case, well, hell, let's go do it. So, and I've never looked back. And so that's probably, and it wasn't anyone who gave me that advice, but don't be afraid of failing. I think it's a really good piece of advice, because we always will, like jumping on the bike without any training wheels, you're going to skin your knee a few times, but get back up on the horse and get on with it. Obviously the best piece of advice is that one, talking about my dad, a fool and their money are easily parted, and again, it goes back to education and learning from industry leaders like yourself, mate, in the Australian property world, and just really trying to surround you. I guess the best piece of advice is you are the average of the 5 people you surround yourself with. So if you're surrounding yourself with a bunch of losers, go and change your networking circles, and your net worth is a direct result of your network. So there's 2 little bangers in there for anyone out there who's writing those down.
Love it. Yeah, they're absolute crackers, mate. Absolutely spot on that one. Okay, what about a personal habit then that contributes to your investment success? Yep.
Well, it's changed over the years, but there's obviously I'm very, very physical. I love going to the gym. I love going for a run. I love going surfing. I love getting outdoors. And if I don't do it, I get a bit of cabin fever. So I know that I have to do it every single morning. And I'm a person who's up early and doing it in the morning. I'm not an after work type of person to work out. I just can't do it. I don't have the energy. The second thing to that is I've found and discovered meditation. Through helping, mental calmness and all that sort of stuff, just trying to stop the chatter in the head a little bit, understanding that it's okay to be present and be in the moment. I think that's really, really important. And a third one is journaling and writing to-do lists down. They're hugely important. Get it out of your mind again and onto paper. So you can fill your mind up with other awesome stuff, because it's like a sponge, and it just you can only hold so much water. You've got to let it out every now and then.
Yeah, spot on, mate. But tell me, because a lot of people that I've interviewed on Get Invested talk about the benefits of meditation, but there's a very broad spectrum of definitions of what meditation entails, anywhere from, thinking about your breathing at one end to sitting on a hill in a Tibetan monk outfit with your palms outstretched staring at the horizon. What's meditation mean to you, mate, and what do you do?
Yeah, I'm only a newbie at it. I'm still on the one end of that scale. I'm no Tibetan monk yet, but I think it's about being okay in your own skin, and that's really tough. And as you get older, you want to impress someone, or you want to do this, or social media, all this sort of crap. But just being mentally okay with where you are in life. And there's nothing wrong with having dreams and goals and 10xing, all that sort of stuff. Love all that sort of stuff. You've got to have it, but you also got to put it into perspective, and you've got to have the mental awareness to be present in the moment and be engaged with someone who's talking to you, not on your phone or doing something silly, out looking over their shoulder doing something else. So just trying to be more self-aware. I'm on one end of the scale. I'm sort of really the beginner breathing, but it helps me fall asleep, and it helps me get up of a morning and just take that time to have a little bit of mental quietness before you get on and start your day, because we can always jump up and turn the emails on and dive straight into it and do the to-do list, and you've got to remember that you've got to just take a pause every now and then, and if you don't have the skills to know how to calm the brain a little bit, just to say we're going to have 5 or 10 minutes here just trying to think about nothing. It's like we go and work out at the gym all the time and work all your muscles, but working the brain muscle is also really, really important to have some bit of a mental clarity to allow yourself to grow and be a great entrepreneur. So,
love it, mate. No, that's awesome. Mate, just to sort of wrap things up generally, if you were to speak to a school leaver, someone who's just finished high school, about to think about where life's going to take them, what will you advise them to invest their time, their money, and their skills in to create freedom long term?
Oh, mate, that's a bloody good one, isn't it? Jeez. Because my number one answer is go and backpack around the world, because honestly, that has been, out of all the experiences that I've had, I'm Australian through and through, but getting out of your own comfort zone, and challenging yourself to do something different is, I still remember the day that I left Australia when I was 21 years of age, and sobbing on the plane and whatever, going to Peru, South America, on this awesome backpacking trip, and I'll end up being away for 2 years. And I just remember, you take that one step and you never look back, and go out and experience the world. I think that's, when you're young and you're coming out of school, you have all this pressure of, I've got to go, I've got to do uni, I've got to do all this stuff. You may, and looking back on it, I was fortunate enough to know what I wanted to do, and I'm now not in my career anymore. But it got me to a point where I'm now more self-aware of how I've evolved over time. But part of that journey was going and getting lost around the world and experiencing new cultures and seeing people struggle and meeting new people and just growing, sort of developing that street awareness. And that's as a young leader, continue to educate yourself in certain things, but also. It goes back to that other thing that I was talking about. Don't be afraid to fail and give it a crack, and go out there and challenge yourself a little bit. I think that's really that's probably the best piece of advice I've got for them. Probably not the one that their parents want to hear, but it's definitely something that's helped me, mate. In my growth.
I just think the resilience, the personal resilience that comes from travel. There is no better teacher, because you have to become self-reliant. No. You have to reach out and build relationships with others. You become used to dealing
strangers,
with new places, new faces, new languages. It's just that there is no better cauldron for self-improvement, mate. I would absolutely 100% agree with you there, and I think that's just awesome advice, mate. So, no. This has been an awesome chat, mate. You've been very, very generous with your time. Before we sort of close off, though, what's next new and exciting for you and your business, mate? Because I know there's a book in the wings. Tell us a bit about that.
Yeah, so I had the benefit or the pleasure of interviewing you, mate, on my show called Investing in the US and Aussie's Guide to US Real Estate. And I started that show about 3 years ago, really to educate international investors about the benefits of investing here and just telling a little bit about my journey. And through that process, I've interviewed really the top industry leaders here in America about real estate. But I've now can niche and pivot into, I'm talking more about business, general and stuff about creating businesses and creating ecosystems and brands and mission statements, all that sort of good stuff.
Yep.
And through that, I've created now the book, which is called Investing in the US, which is called aptly titled The Ultimate Guide to US Real Estate. And again, is about my story about a foreigner coming to the United States and making a go of it, and really sort of stepping people through the sort of the high-level stuff that you need to know about, when you first move to the United States, about bank accounts and structuring and all that good stuff. So, that's coming out between now and the end of the year. And then we've got a second book coming out, which is going to be a pretty cracker, if I do say so myself. It's I started a group here, mate, called the Aussie Real Estate Mafia, and it's a group of about 8 or 9 of us, and it's all blokes that I've interviewed on my show. Awesome. And they're all Aussies, and they're all out here in the States doing real estate. And we're coming out with a book in early 2019 called 10,000 Miles to the American Dream. And everyone's got an individual chapter, and it's going to be an awesome book. So keep your eyes peeled for those two. Investing in the US, the Ultimate Guide to US Real Estate, and then the next one coming out in the 10,000 Miles to the American Dream. So yeah.
That is very exciting, mate. That'll be a fantastic read, actually. Mate, your discussion has really picked up my interest personally, and I know there'll be a lot of listeners out there who are at that stage where they've looking at setting up or have already established a self-managed super fund, and the sorts of returns you're getting from a cash flow basis, but also a capital uplift basis, are pretty exciting. What's the best way for the listeners to get in touch with you, mate, to find out more?
Yeah, mate. So there's a couple of ways. You can go to my website, which is www.reedgoossens.com. You can also check out you can check out 2 other. Reedgoossens.com is probably where the best place is to hit me up, and you can check out all my blogs and podcasts and all that sort of stuff and books. And through there, I can direct you to my 2 investment vehicle arms, Wildhorn Capital and RSN Property Group. So they're sort of more sitting in the back, and up the front is the Reed Goossens personal brand. So check that out. And if you're listening to any podcasts, check out mine as well. And if you're ever in LA, hit me up at info@reedgoossens.com, and always keen to go for a coffee or a beer, or any Aussies that are just interested to learn more. I'm sure LA is a pretty popular spot on everyone's destination when they come to the United States, when they cross the pond. But I'm always here and always keen to have a yarn about some real estate. So yeah,
fantastic, mate. And just for those that to get the spelling right, Reed is R-E-E-D and Goossens is G-O-O-S-S-E-N-S, because I found that out trying to use a single S when I first Googled you, mate, and worked it out pretty quickly. So, mate, look, really appreciate you spending some time with me, mate. The audience is really going to get a lot out of that. I think it's really going to open their ears and eyes to a fantastic alternative opportunity, because it's fair to say that we have the dim prospect potentially of a Labor government coming in federally here early next year, and they're making big noises about having a crack at depreciation and capital gains discounts, which if that unfortunate situation does eventuate for future and new investors, that will significantly change the landscape from a holding cost and a capital growth perspective. So it's a very timely discussion with you to start lifting the eyes and looking at horizons beyond our national boundaries. And given my own comfort and interest in the US, I can see that there's some real merit in discussing those opportunities with you further, mate. So thanks for coming on board.
My pleasure, mate. And you're doing an awesome job with this show, by the way, so well done.
Thanks, mate. Look forward to catching up soon. Thanks, Reed.
See you, bud.
Bye, mate.
Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you live forever and live as if you'll die